This is our video blog for Monday, April 25th, 2011. And like most days, we really want to trade and buy the strongest currencies versus the weakest ones. Today we had a pound that had more weakness than strength. The daily, weekly, monthly trend was down. Same thing with the CAD. The euro was strong today. The Swiss was strong today. It's not surprising the Swiss is strong because, it's heavily correlated with gold, and gold's, going up. Swiss is strong. Between the dollar and the yen, the dollar has a weaker weekly and monthly trend. The daily trend's also down. The yen, the daily trend shifted up. The weekly and monthly trend are less weak than the dollar. So if you see weakness in the dollar, you would prefer to sell the dollar than the yen. And so basically today we're looking for buys in the euro dollar. We're looking to sell the weak dollar against the Swiss. Both the dollar and the CAD are both weak longer term. If you see a spike down in this and strength in this, you can certainly trade it, but it's less likely to continue. If both currencies are weak over the last day, week, and month, then it could really go either way. You want to trade in the direction of where all the forces of the market are. So obviously, the euro dollar buys and the dollar Swiss sells were the most high probability, most likely trades to work. So starting today off, the price is underneath the hourly. When that happens, it's more likely to be down. But once it breaks back above the hourly, the longer term trend is up. You look to get into this trade, and we're going to add the new tools to this chart right now, the FX tipping point and FX momentum. Force equals mass times velocity, and the tipping point basically shows the percentage of currencies going up or down, and then the FX momentum pro shows the velocity of those moves. So if you saw this little sideways range last night where it came down to the previous day's high and then broke out right here, that's not a bad trade to get in because the longer term trend's up. And initially you can see there's a lot of participation. Most euro pairs are going up, dollar pairs are going down, and they're doing so with more force, more momentum, velocity, speed than normal. So the force of the market is quite strong, and you can see it breaks out, and it obviously breaks the hourly moving average, which many times once price is underneath it acts as a resistance point. So you got into that trade right here if you're an aggressive trader. If not, when it breaks above the hourly and pulls back and doesn't go back underneath the hourly, you can see on the way up there was a lot of velocity to the upside, and during the pullbacks there was no weakness in the euro pairs nor strength in the dollar. So a very high probability trade right here. You never know what you're going to get. This shot up about 10-15 pips and went sideways. You can see initially there was a lot of force behind it, both a high percentage of euro pairs going up, dollar pairs going down, and with decent momentum. And then guess what happened here? You start having a very high percentage of euro pairs going down, but without a whole lot of momentum, and then it tried to go up again. Less euro pairs are going up than before, and there's no velocity behind the move at all. There's no speed. So the force is nothing. So, it already went from 30 up to 70. It's a 40 pip move. And during dead days, that's a decent sized move. During active days, that's nothing. But there was no momentum to carry it higher. So you got out of your trade. And then during this pullback, there was a smaller percentage of euro pairs that were going down than before. And again, the velocity to the downside is nothing. So, especially on a tick chart right here around 2, not a bad place to look to buy. And then the market goes up again, initially with some force, and then the force disappears. So either you get out of your trade when it goes sideways here with another 10-15 pips, or you just simply move up your stop underneath the lows, and then gradually it works its way up. Now when the market doesn't have that much velocity and speed of movement, typically you're not going to make that much. So what I would do is draw my fibs on this first wave, and when it came up to the fib target right here, upper containment band, monthly pivot level, broke above the previous day's high initially with a lot of force, then the force disappeared. I would get out of that trade right here and probably miss this extra 20 pip pop it made. But notice up at the highs, usually the containment bands, or when it goes a few pips beyond that, sometimes it goes 30 or 40 pips. It doesn't always just stop on a dime like this. But notice initially the velocity and the percentage participation of euro pairs going up, dollar pairs getting weak was really high. The percentages were decent, but the volatility dried up. And then, euro pairs started going down right here. So if you wanted to go short, notice a very high number of euro pairs going down, Dollar pairs getting stronger right here, but they're not doing so with tremendous momentum. So because it's a counter trend trade, you might want to get out somewhere near the previous day's high, which is likely resistance. And because it double bottom right here with a lower percentage of euro pairs going down than before, and because the velocity on the down move really wasn't that intense compared to all the big, there weren't too many follow-up bars, but there were a lot of spikes and momentum to the upside, very little to the downside. Aggressive traders might have got in right here, and initially, decent percentage of currencies going up, but with no momentum, and then you got a spike here, and as it goes sideways, guess what? The number of euro pairs going up is nothing, the upwards volatility is nothing, and you're out of your trade, when it breaks down underneath here. You're in at 96, out at maybe 03, maybe you made 7 or 8 pips. And because it didn't even come back up to the high, this is a perfect 1, 2, 3 pattern, and the momentum died out, there's no velocity to the upside. Aggressive counter trend traders would have gone short right here, and this is your first profit target, and the hourly is the second. But as it starts coming down, this is where the tool really benefits you. If you do a counter trend trade, usually only expecting 5 to 15 pips. But if you see a high percentage of them with decent volatility, usually in the next bar or two it continues. And a decent percentage of euro pairs going down, dollar pairs going up, again with decent volatility, it's 50-50 likely to break the previous day's high here. And if it breaks that, it's probably 60-70% likely to go down to here. So again, a very high percentage of them went down, but they didn't go down by much. So you might move your stop above that bar's high or get out of half your trade with only 10-15 pips. And then it took off. Notice high percentage participation and a lot of speed. The force of the down moves a lot, it's very likely to go down another 10 pips and hit the hourly in the next bar or two. Go sideways, but there's no upward volatility. All right, now at this point it does go up with a decent percentage of them up, but without much force. So if you're in this trade, you might get out of half, put your stop above the highs here, and now it's starting to go down. There's not a whole lot of momentum, so you're expecting the hourly here to act as support. But on the next bar, guess what? Some of the weakest of the euro for the whole day. A very high percentage of them going down with decent momentum. So it's likely to go down lower in the next bar or two. And it does, as you can see. So you might get out of your trade here. The euro dollar is a very strong pair. You got a great counter trend trade and made 20-25 pips on that. Quite a few upwards moves where you made 10 or 15 pips, or if you got in and saw the momentum to the upside with, when the red came in, very little momentum to the downside, all you did is just kept tightening your stop. That's how you would use it to trade longer term. Dollar Swiss, again, very weak currency. It showed it on here, the weak dollar, super strong Swiss, and the price was underneath the hourly, and we're going to remove these tools and use the Tipping Point and Momentum Pro on here. These are available to all active traders. If you meet the minimum trade volume requirement, we give you those for free as a reward. And we feel that people who learn to trade and are making money will trade a lot more lots if they have tools that give them almost a real-time feedback. So the market's kind of going sideways right here. It's underneath the hourly and then breaks down right here. This would be a decent place to go short with your stop right above the hourly. Very tight 10 pip stop. And notice at that time right here, a very high percentage of dollar pairs fell and Swiss pairs got stronger, but they didn't do so with that much momentum. And so guess what? Immediately it went back up. But it went back up with a decent amount of force on one bar, but without a whole lot of dollar pairs going up and Swiss pairs going down. Sometimes that happens. So if you saw them both shoot up, and your stop was above here, above the hourly, you might just decide to bail on the trade with a 4 or 5 pip loss and avoid another 6 pip loss. But in this case, not a lot of dollar pairs went up, and so when it goes sideways here, you might be a little alarmed by it and tighten your stop a little bit. But then the next bar, most dollar pairs are slightly inching their way down, Swiss pairs going up, and then when it breaks down here, look, very high participation. Almost all the dollar pairs are falling and Swiss pairs are going up, and they're doing so with decent momentum. Bar after bar after bar of slightly above average. So this is your support area and where you're likely to get out of the trade with a profit, and it just kind of goes sideways here. So I would always exit half when the market goes sideways and tighten my stop, and then it decides to go down again. We're still on half, and if you just started trading at this time, anytime you see a sideways range of 30 minutes to 2 hours, it's a very high probability, a support area where there's likely buying, and there is. It stops the move down. it's likely to cause the market to go up, but there's no movement up. So there's no real aggressive buying here pushing prices higher. And if you weren't already in a trade, you'd go short here. You might even add to your position. And the fib targets are a good place to get out with a profit target. And as this thing finally breaks right here, very high percentage going down with a lot of volatility, and then kind of goes down here sideways. Very high percentage of them going down. The volatility slows up a little bit, so you might have got out of half your trade here at 03. You're short at 17, and then the second half it just explodes down. And usually these bars where all of them are exploding and they're way underneath the lower containment band, the first sign of it going up, you want to get out because it's already 20-30 pips underneath the lower band. But you made a fortune on that second explosive move. And when they're underneath the lower containment band, sometimes they continue and sometimes they don't. So it becomes really iffy whether you want on this move up here to sell it. I would always wait for the price to break if you were. But notice on the way up here, super high percentage of dollar pairs went up, Swiss pairs went down, decent volatility. So you're not in that trade. Might have went short right here, but again, look, not a whole lot of them were weak like they were before. And so guess what? The price kind of dips its way down and then shoots right back up. And that's what you're going to see. If you see a market make a 1, 2, 3 low, this is exactly opposite of the dollar or the euro dollar. It came down again with less weakness than before. The momentum to the downside is nothing. You might have bought this breakout here with this as your profit target, 25, 30 pip profit target. And look, it goes up with a lot of momentum and a lot of volatility, mostly to the upside. If you see a bar that shoots down here with decent momentum, you might want to either exit half your trade or tighten your stop underneath those areas. But you wouldn't have been stopped out here, and it went up right to the next profit target level. And guess what? The strength all but disappeared even before it started pulling back again. Look, momentum's gone. So you're out of your trade. And that's why I say I love this tool so much, because in the past, you don't know whether you want to exit with a 5 to 15 pip profit or try to hold on and catch another 20 or 30 pips. With this, if you see it going up in momentum, if the percentage participation is going down and the upwards volatility is going down, guess what? There's not enough force to push it up. And especially since the longer term trend is down, this is a decent sized pullback right here. You might even, once the momentum to the upside falls off a cliff, you might even decide to go short here, and you didn't make much on the drop, but you made 10 pips trading with the longer term trend. It's that simple.